What if I told you there's a major disconnect between headlines and economic indicators right now? Treasury Secretary Bessent recently stated the housing market is stuck right now, but it will unfreeze in weeks. While data from Housing Wire shows mortgage rates could potentially drop below 6% if spreads return to historical norms, reducing current rates by 0.82% to 0.92%. In the next few minutes, I'll walk you through 9 crucial graphs that explain why this market unfreeze is imminent and what these economic signals truly indicate for your buying or selling decisions in 2025. Could the 10-year Treasury yield hold the key to unlocking lower mortgage rates this spring? The numbers are telling us something important about where the housing market might be headed. Looking at the data from last week, the 10-year Treasury yield was just below 4.2%, positioning it less than 0.5% above the lower boundary of expert forecasts for 2025. The Treasury yield directly influences mortgage rates, with analysts projecting the 10-year yield will float between 3.8% and 4.7% for 2025, translating to a mortgage rate forecast range of 5.75% to 7.25%, a critical relationship for homebuyers and sellers to understand. We've seen substantial movement since January, with yields declining from 4.79% to 4.19%. This drop reflects how bond markets respond to economic softening and suggests we're moving toward the lower end of forecast ranges, though reaching the 3.8% boundary would require more substantial economic concerns beyond mild weakness. The bond market's anticipatory nature provides valuable insights. Bond investors often position themselves ahead of official policy changes when they sense economic weakness. We've already seen this with 36 basis point reduction since January 14th, smart money detecting shifts in economic conditions before the Fed takes action. Throughout much of the past year, mortgage rates remained near yearly forecast upper limits, creating a challenging environment where buyers face affordability issues and sellers struggle with lower transaction volumes. White House economic officials are implementing specific policies like government workforce reductions and expanded oil production to fight inflation, showing a coordinated effort to influence housing affordability through macroeconomic levers. For those waiting for lower mortgage rates, the path likely requires economic softening or a stock market correction substantial enough to trigger a flight to safety toward bonds. What's revealing in Treasury yield patterns since 2022 is that every meaningful drop in mortgage rates has coincided with concerns about economic growth, not merely improvements in inflation data. This suggests economic health indicators provide the clearest signal of where mortgage rates might be heading next. If you've been following me for a while, you know my experience has taught me that informed consumers save money and are happier during their move. That's why I deliver market reports from numerous sources, analyzing the U.S. housing market from all angles. Today's report from Housing Wire is its view on mortgage interest rates and the economy. If you're not a subscriber, please click the thumbs up like button and subscribe now to get all my new content when it is fresh. If you really want to know what's going on in housing, to see and hear the data explained, to learn the tips and tricks that put extra money in your pocket, then subscribe now and I'll keep you in the know. Beyond economic indicators lies a market anomaly that's essentially placing an invisible tax on home buyers. If you've been watching mortgage rates and wondering why they haven't dropped more significantly despite improving Treasury yields, there's a crucial market mechanism you need to understand: the mortgage spread. The mortgage spread, the difference between the 10-year Treasury yield and the actual mortgage rates, typically hovers between 1.6% and 1.8% in healthy markets. This relationship has been reliable for decades. Currently, these spreads remain significantly wider than historical norms, effectively keeping mortgage rates artificially elevated. Homebuyers are paying more than current economic conditions would otherwise dictate. For perspective, if spread levels had remained at 2023's worst levels, today's mortgage rates would be approximately 0.75% higher than they are right now. Spreads have improved considerably since their 2023 peaks, providing some relief even as overall rates remained elevated. Market analysts have observed that when bond yields climb higher, spreads tend to improve, but when the 10-year yield falls, the spread doesn't compress proportionally to push mortgage rates lower. This asymmetrical relationship explains the stubbornness of today's mortgage rates. Looking ahead to the remainder of 2025, forecasts suggest modest improvement in mortgage spreads, approximately 0.27% to 0.41%, below the 2024 average level of 2.54%. More importantly, if mortgage spreads return to historical norms today, mortgage rates would immediately drop by 0.82% to 0.92%, pushing rates below the critical 6% threshold without requiring any Federal Reserve action. Treasury Secretary Bessent's comment about the housing market being frozen points directly to this issue. The elevated mortgage rates caused by wide spreads are keeping potential buyers on the sidelines and sellers hesitant to list properties. A normalization of spreads could unleash substantial pent-up demand and transform the housing market virtually overnight. While the frozen housing market Secretary Bessent described isn't uniformly solid ice, it's showing stress fractures that most analysts are completely missing. The weekly housing data reveals a market that's beginning to crack in subtle ways that contradict what you might expect from headline statistics. These early warning indicators paint a surprising nuanced picture of what's happening beneath the surface. Purchase application data this year tells a complex story, with 2 flat readings, 3 negative readings, and 2 positive readings, creating a slightly negative trend overall. This mixed performance signals market uncertainty, though it's actually better than the same period last year, suggesting buyers are slowly adapting to high rates while remaining cautious about making long-term commitments. This caution becomes more evident when examining weekly pending sales contracts. We're seeing 324,432 contracts in 2025, compared to 337,271 in 2024, a concerning 4% year-over-year decline. Think of these contracts as the market's pulse, and that pulse is weakening. The silver lining? Current numbers still outpace 2023's 317,190 contracts, placing us in a sandwich pattern between recovery and regression. Against this backdrop, housing inventory reveals an even more troubling story. Rather than increasing as seasonal patterns would suggest, inventory actually dropped from 640,221 to 639,485 last week. This shortage resembles a desert oasis gradually drying up. Where once flowed 962,785 listings during the same week in 2015, we now have 50% fewer homes available. For viewers anticipating a housing bubble, today's inventory is 84% lower than 2007's 4 million available homes. New listings provide minimal relief, with just 53,394 properties entering the market versus 52,189 last year, a mere 2.3% increase. During the housing crash years, weekly new listings typically ranged from 250,000 to 400,000, highlighting our current supply drought. The clear signal of market strain comes from price reductions. Currently, 33.7% of listings have seen price cuts, up from 31% in both 2024 and 2023. This reflects sellers adjusting to reality as forecasts project only 1.77% home price growth for 2025, which, after inflation, means negative real home price growth this year. Beyond sellers adjusting their expectations through price cuts, a less obvious but potentially more impactful force might soon reshape the housing market landscape. The Trump administration's federal workforce reduction plans could be the hidden catalyst that finally breaks the mortgage rate gridlock. And there are already early warning signs in the data that most analysts haven't connected to potential rate drops. These government job cuts represent a significant economic shift, not just typical political reshuffling. Federal workforce reductions extend beyond direct government employees to affect contractors and adjacent industries, creating employment ripple effects throughout the economy. Notably, jobless claims data already shows concerning spikes, and these aren't even related to the federal layoffs that just begun. This indicates the broader labor market is weakening independently, creating a perfect storm when combined with the planned government cuts. Treasury Secretary Bessent's surprising prediction that the housing market will unfreeze in weeks likely stems from internal projections about these workforce reductions. His economic team understands how these cuts will directly impact unemployment figures and subsequently influence the Federal Reserve's monetary policy decisions. The Fed has established a clear threshold, an unemployment rate of 4.3%. When job losses push toward this level, history shows the Fed responds aggressively with rate cuts. The bond market, however, typically moves before the Fed acts, anticipating these policy shifts and sending mortgage rates lower in advance of official action. The White House appears to be implementing a strategic three-pronged economic approach: increasing labor supply, reducing aggregate demand, and driving down the 10-year Treasury yield. Government workforce reductions serve all three objectives simultaneously, directly influencing the very factors determining mortgage rates. For home buyers and sellers watching from the sidelines, the latest jobs report combined with upcoming job openings data could provide early confirmation of this labor market shift. These employment indicators might trigger bond market movements that push mortgage rates toward the psychologically important 6% threshold, potentially without requiring the Fed to make a single official move. As we wrap up today's analysis, let me highlight something that deserves your undivided attention. While everyone fixates on inflation readings, the jobs data might actually be the true driver of mortgage rate movements. The job openings report on March 7th could provide the first tangible evidence of labor market changes that would push bonds in a favorable direction for homebuyers. The bond market typically responds to employment weakness before the Fed makes any official announcements, creating those critical rate drop opportunities. With labor market indicators and potential Fed rate cuts converging, we're witnessing the groundwork being laid for mortgage rates to approach that pivotal 6% threshold. If you're planning on selling your home this year and you want to squeeze every single dollar from the sale, then I have just the video you need. Check out my new video, 2025's Hottest Home Selling Strategies You Need Now, where I reveal 10 must-use techniques to maximize your home sale profits.